Rick, it is all yours.
Thanks, Sean. Appreciate that. For everybody on the call, hello. Thanks for spending 45 minutes or so out of your busy day today to talk about what we think is a pretty important topic. I'm going to go off video now so I can look at my second screen for slideware purposes, but hopefully everybody can see the screen that I have here talking about trade-off consumer. And this is our mid-year 2025 review of a series of data that we collect every 6 months, and we've been doing this for a couple of years now. So I know this call is a mix of folks who have been on these webinars in the past and some folks who are net new. For those of you who are net new, just a quick rundown on the agenda. I'm going to give a very, very brief introduction to Big Chalk as a company. I think most of you know who we are, but I know that some of you don't. I promise I'll keep that very, very brief. And then I'm going to give you an introduction to the trade-off consumer segment that, as I said, we've been tracking for about 2 years now. I'll give you a little bit of the backstory on why we started tracking these consumers, how they appeared on our radar, and what they mean. But to really understand this consumer segment, we have to zoom out for a minute and look at the state of household budgets at large at a nationwide level so that you have the context when we go back in and talk about the trade-off consumer and some of the select category findings we're going to present today around the trade-off consumer. That context is really important for you guys to understand where they're playing right now in our economy and what it means if you're managing a brand. And we'll talk a little bit about the risks and or the opportunities that these consumers represent. And if I do my job right, we should have 5 to 10 minutes left over for questions at the end of the call. So again, thanks everybody for joining. Thanks to Acosta for helping us promote this information. And hopefully everybody, this will be a great use of your lunch hour if you're in the central time zone. Okay, so who is Big Chalk? Again, I'll be really brief about this. We are probably the quietest analytics and research company that you've never heard of that's working with a whole bunch of brands that you definitely have heard of. We've been around 8.5 years now. I like to say we're a startup. I don't know if it's still fair to call us one at that advanced age. I feel like it's a startup every day when I come in and go to work because of the energy and the excitement that everybody here brings to the table and that our clients bring to the table. Even though we are a young company in terms of chronological age for the corporation, we are fortunately or unfortunately not a young company when it comes to the people who work here. We've all got about 20 years experience in CPG, quick serve restaurant, retail analytics, peppered in with some other consumer brands that we've worked at from time to time over the years. But we bring a pretty deep set of expertise and bench to the table whenever we engage on a project. And we also bring a little bit of a different approach to how we engage. We don't sell raw data. We don't sell software tools. We are the folks who will use open source tools to deliver data to you. We will work with your data, but we really lean into the human-oriented element of delivering analytics. We're the guys you talk to if you need to understand not just what the data says, but what you should be doing about it. And hopefully that'll be readily apparent as we talk through the material today around the trade-off consumer. So that said, who are these folks and why are we tracking them? A little bit of history on how this came about at Big Chalk. It's a combination of things that we were seeing in the data about 2 years ago, combined with questions that our clients were coming to us and asking. And it really boiled down to a couple of broad things. if you looked at a lot of the macroeconomic indicators, especially 2 years ago, but even still today, the economy seemed, and to some extent seems, really, really strong. The stock market is at record highs. Um, Unemployment is relatively low, although starting to get a little bit shaky. Consumer spending has held fairly strong over the past couple of years. But for those of you who work in CPG and in quick serve restaurants specifically, if you were looking at your Circana data or your NIQ data, you were likely seeing volume decreases and other types of slowing in consumer engagement that probably appeared worrisome. And so that led us to the question, okay, how can things look so good at a macro level, but when we dig down into specific categories, we start to feel like things might be a little shaky. And that, of course, if you're a brand manager, leads to the next obvious question, which is, should I be investing for growth? Like, are we still on a growth trajectory as an economy? Or do I have to start playing defense? And if I do, how am I going to do that? And what we've realized at Big Chalk is using the standard data sources that we typically use to run CPG analytics projects and restaurant focused projects. Those data sources were not holistic enough to understand what was happening at the big picture level. So we went out and we recruited about 75 federal public sources, trade association sources, combined those with all of the well-known syndicated sources, and then combined that data with a proprietary census balance survey that Big Chalk executes every 6 months. And that led us to the total view of household budgets and a better understanding of why things can look so good on one end of the spectrum and look a lot less good on the other end of the spectrum. And that's how we discovered these folks that we call the trade-off consumer. So, how do we define a trade-off consumer? Well, first off, you have to understand what we're tracking. In our macro surveys, we track seven macroeconomic categories. We track home expenses, auto expenses, clothing, leisure travel, restaurant activity or dining out, groceries, which most of you on this call are going to care deeply about, and then entertainment, namely out of home movies. And what we found was that there was a statistically significant break between the set of the population, the US population at large, that told us they were cutting spend in four or more categories. So we grouped those folks together, and those are the folks that we call the trade-off consumer. And as we evaluated that segment of our data, what we learned was really interesting to us. The trade-off consumer is not a low-income consumer, not predominantly. They skew slightly lower than the US average, but not a lot. And they don't have any racial, gender, or age-based skew. They track right along US Census average lines along those categories. So if you think about your own consumer marketing efforts and how you might be segmenting and trying to reach people with your marketing messages, you can't just pick any of the standard demographic skews to try and find the trade-off consumer. However, this trade-off consumer has a very interesting mindset. We're going to talk about that later in this presentation, so I won't go too deep into it here, but they do behave differently than the US consumer at large. And there's also a lot of them. So the trade-off consumer segment, when you look at the total US population, has reached 34.5% of US households. That's a big number. And it's been ticking upward. When we first did this study back in June of 2024, it was at around 28%. It was 33% in November last year when we refreshed the data. And it's leveled off a little bit, but still ticking upward at 34.5%. So this consumer segment, even though they're a little bit hard to find using traditional means, they're pretty big, big enough that we think most of the people on this call, and frankly, most of the people in our industry, really need to care. So that's the trade-off consumer, how we arrived at them, the methodology for finding them. Let me take a zoom out, if you will, and talk about household budgets and what's happening in the economy at large. Because as I said in the open, to understand the trade-off consumer, you really kind of need this higher level context. So getting back to that divergent question about why macroeconomic indicators can look really good or fairly good, but some of the microeconomic data at a category level may look kind of bad. We have to start with the total household budget and how consumers are spending their money every week or every month. And one of the things that's been very positive over the last, not just the last couple of years that we've been doing this study, but over a longer period of time, is that household incomes have been growing at a fairly advanced rate. We've averaged about 5% annual household growth year over year for the past 5 years or so. Now, there's some cracks starting to show just recently in that data, and those cracks are probably tied and corollary to the cracks that we're starting to see in the employment numbers, which I'll talk about in a minute. But generally speaking, over the last 4 or 5 years, things have been good. You can see here household budgets with about a 5% growth, give or minus a couple of tweaks that we've made to our methodology, now stand at about $86,000 a year. And you don't need to read every line item on these charts, but if you scan all the way down to the bottom and you look at what that means from either a gross or net budget surplus standpoint, the average household on net is still coming out over $2,000 ahead at the end of the year. And this is caused, again, by growing salaries, growing wages, and over the last 2 years, a decrease in inflation. Now, the big question that everybody had going into this refresh of our data is what's going to happen as tariffs get implemented. So we took a category by category approach to tariff expenses using projections that come out of Goldman Sachs, the Yale Budget Lab, and Morgan Stanley's economics group to apply what we think will be the effective tariff rates on a category by category level. And while that red number on the gross budget line may look a little scary, when you factor out personal savings, the net budget line is still net positive for most consumers right now. Now, the problem with tariffs, as I think everybody on this call knows, is they're a little unpredictable. It's hard to say that these numbers are going to hold. They might get better, they might get worse, depending on how certain things wind their way through the legal system over the next few months. But even if things end up on the higher end of where we're projecting, we don't think that household spending is going to completely collapse. The other things that we take into consideration at a macro level are credit card debt and delinquencies, which are high when you look historically at some of those metrics, but they've stabilized. They haven't gotten any worse this year. As I just said, the tariff effect hasn't really taken place yet. And the unemployment numbers, obviously, there's been a lot of news about that in the last 6 or 7 days, which is after this slide was created. But I would still hold by the bullet point here that it's hazy, but it's not concerning. So we had a bumpy first half of 2025. Second half is looking more stable. Things are very unclear when we get into 2026. So big data dump on macroeconomics. Hopefully you all stayed with me through that. But let's talk about how consumers are feeling about all of this. So again, some good news here, especially good news if you work in the grocery category. The categories, the number of categories that consumers are actively trading out of has held fairly stable from last year to this year over our survey data. Last year, 2.4 categories on average. The consumers were trying to cut their spend in, only 2.5 in the most recent set of data that we collected in June. So that number held pretty stable. And if you look at the grocery category specifically, the percentage of households that are trying to cut their spend in grocery actually ticked down by 2.5 percentage points. So that's something that we're optimistic about for the back half of this year. Again, getting into 2026 a little bit harder to predict, but right now, as far as grocery is concerned, we feel pretty good. For our friends on the restaurant side of the economy, things are probably going to be a little dicier. Same with leisure travel, although it seems to be holding its own with the recent earnings reports that just came out from the major airlines. But if you look at consumer intent to cut budgets on leisure travel and on dining out, if you look at the yellow bar, that has ticked upward compared to the pink bar, which was fall of last year. So when you're looking at these charts, smaller bars are better. And in groceries case, it's going in the right direction. With restaurants and leisure travel, maybe not so much. That's the total economy, the total US consumer. When we look at the trade off consumer, and I'm going to dive into these guys in greater detail later, but when we look at the trade off consumer, just compared to the total average for context, you can see much more stark in their desire to cut their budget. So, grocery buying, 92% of trade off consumers are actively looking for ways to cut their grocery spending. 87% of them are cutting going to the movies. 87% of them are cutting their dining out behavior. And in comparison to the average US consumer, these numbers probably look a little scary, especially to those of you who haven't been on these webinars in the past. They're concerning, but they're not as scary as they look. And I'm going to get into those in a minute. Now, for my friends who are in grocery, I'm going to take just a quick look at groceries. There are some changes in shopping patterns that we've been tracking over the last 2 years that are potentially concerning depending on the role you play in the CPG industry. What we are seeing is consumers are visiting more stores to find the best deals and the best value on the products that they shop, and they are definitely buying more on sale items. So if you look at this set of data here right in the middle of this chart, it's already at 36.6%. When we first started tracking this, it was at 32.7. That's a 4 percentage point jump. Huge jump. So the ramifications of that, for most of you, probably don't need to be told. Your price promo, your trade strategy, going into the back half of this year, definitely going into 2026, this is going to be a pretty big deal for you to get straight. And then the other thing that we're seeing, and again, also concerning, there's an indication that folks are just trying to buy less product. They're trying to buy less groceries. And there's a couple reasons for that. Economic conditions, specifically with the trade-off consumer, are one. There's also another big thing that's going on that I'm going to talk about in a couple slides that's influencing this. But if you're a Circana data nerd or an NIQ, XAOC data nerd, you're probably seeing this in your data as well. Volumes are noticeably declining. Not huge numbers, but they're declining. So it's a point of concern. Now, what we were just talking about is intent. So all the last 3 slides, that data is about what consumers say they are doing or are going to do. What about what they have done in the past? So we look at intent in combination with participation rates because we're always curious to see if consumers, when they say they're going to cut spend on a category, actually go through and do it. So I'm sharing this data with you for 2 reasons. One, for those of you that are from the restaurant side of the business that are joining this call, this data will be interesting to you. Two, this data proves out the predictive nature of the work that we've been doing over the last 2 years. So back in June 2024, when we polled trade-off consumers about where they'd be cutting spending, and they said out-of-home dining and leisure travel primarily, when we collected this data 6 months later, they had done so. So back in June of last year, about 80% of trade-off consumers said, yeah, we're going to cut our dining out budgets. At that time, 86% of them were visiting a restaurant at least once per week. By Q4, that dropped down below 80%. Now, the good news is it is ticking back up. Hopefully, when we refresh this data in November, we'll see a little bit more positive momentum there. But if you remember the intent numbers from 2 slides ago, we may not see that. So we're telling all of our friends that working in restaurant, buckle down, you may need to grind out another 6 months of tough economic conditions before you see a turn. It's hard to reconcile some of this data. There's a lot of stuff that gets mainstream media attention, like University of Michigan and Conference Board studies. We expect you're going to continue to see up and downs in that data, not just for dining out, but maybe for other sectors as well. We think it's just going to be really tough to get a read on consumer intent from any of those large-scale macro sources going forward. But we feel pretty good about our data. So that's the context. That's what's happening at a high level. Let's dive into the trade-off consumer in a couple of categories, and then we'll talk about how to reach these folks. So again, a little bit of a refresher here. This is trade-off consumer only data. This is not combined with all household data. And you can see how spending intent for the trade-off consumers has changed over the last 3 survey cycles that we've collected. And again, good news on the grocery front. We see that desire to cut spend in grocery dropping from 95 to just a little bit under 92. Again, big scary numbers. People may say, oh, that still sounds horrible. That's a statistically significant shift. Okay, that is a real and material drop in the number of folks who are cutting their grocery budget, which makes us cautiously optimistic. There is probably some corollary between the drop that we see in grocery among the trade-off consumers sent and the uptick in cutting their dining out budget. AKA, people are starting to think more about making that weekly trip to the restaurant or bi-weekly trip to the restaurant, and they're planning to eat more meals at home. Great news for all my friends in CPG, less great news for our friends on the restaurant side, but don't worry, we're going to tell all of you how you can manage this a little better anyway. When we look at grocery as a macro category, there's a couple of things that stand out, I think will be interesting to most of you on this call. First off, brand trade downs. So permanently switching down from a premium brand to a less expensive brand has been trending down in the overall population and kind of trending down in the trade-off consumer population. It's flattened out a little bit. But for those of you who are managing specific branded products, I think the takeaway here, the good news takeaway here, is the pressure on branded products should be stabilizing and maybe even alleviating. If you look at brand switching and volume pack size, buying on discount by volume, this data isn't really moving very much. There also isn't a tremendous amount of difference between the way the trade-off consumer behaves and the total US consumer behaves. But look at small packs. This is a huge deal. So you've got 33-ish% if you take the average here of the 3 collections of trade-off consumers who are actively trying to buy smaller pack sizes. That compares to less than 20% in the market at large. So trade-off consumers are highly sensitive to pack size. Why? They just don't have the discretionary budget at the end of the week or at the end of the month to buy up on larger pack sizes, even if they're getting a better price per ounce on a larger pack or price per unit. They just can't do it. Their cash flow is just too tight, which we'll talk about also in a couple of seconds. The other thing to take away from this chart, however, and what I'm going to show you next, is that these tactics change and sometimes change drastically depending on the CPG category that we're looking at specifically. So these are overall grocery numbers and how people are approaching grocery as a macro category. But to show you how this differs, I'm going to show you two categories, specific categories, cold cereal, and I'm going to show you coffee. And let's see how these two categories behave a little bit differently. So in cold cereal, store brand or private label is not one of the top three brand preferences when we poll consumers about the brands that they're buying most frequently. And if you look at how trade-off consumer around store brand differs from all U.S. consumer store brand, they're basically virtually tied. There's not much difference here in how these two different consumer groups shop this category or put an emphasis on brand. And when you look at their trade-off tactics, how are they trying to maximize their budget? Not a lot of difference between all consumers and trade-off consumers in how they shop on promotion. Heavily promotion-oriented category in cold cereal. When we look at coffee, however, we see a different story. So store brand, okay, it's number 3 on the list of brands that all consumers buy and trade-off consumers buy, but there's a lot more difference in how these two consumer segments approach this category. Much bigger difference between the all-consumer tendency towards store brand and the trade-off consumer tendencies towards store brand. And if you look here, Folgers, which is the number 2 brand that we're tracking nationwide, much higher prevalence among trade-off consumers. So Folgers is a brand, probably through some new product releases that we're aware of, that has figured out the last year how to reach this trade-off consumer and capitalize on it. And then if you look at sale buying, so only buying when the product is on sale or on promotion, great difference. Back in cold cereal, the slide before, these two numbers were closer to equal. They were much larger. In this case, trade-off consumers twice as likely to buy the coffee category only on sale as opposed to all U.S. consumers at large. Now, what does this mean? Not sharing with this data with you to talk specifically about these categories, because I could probably talk for an hour about each of these categories. Nobody wants me to do that. But the point here is that category by category, these behavior types and these trade-off tactics differ. So it's really important to understand trade-off consumer activity specific to your category. Okay. One more thing, a bonus challenge, if you will. In addition to economic challenges, especially in the trade-off consumer set, there's something new that's facing grocery that's just popped for the first time in our data in a way that's big enough where we think, okay, this is big enough that we need to tell folks about it. It matters. And that's GLP-1. And some of you might have seen this. We published a standalone report on this, which is available for free on our website. It got some mainstream media attention this summer. But as you can see, we now have 11.2% of the US population that's currently on a GLP-1, and another 8.3% that's strongly considering moving to a GLP-1 protocol in the next 12 months. So we're going to be at about 20% household penetration for GLP-1s. And if you look at that specific to trade-off consumers, they're actually more likely right now to be using a GLP-1, which is somewhat funny if you think they don't have a lot of discretionary income. How are they pulling this off? But it is something that they are doing at a slightly higher rate than average. This has reached the point where some of the volume losses, depending on the category that you play in, that you're probably seeing in your syndicated data, this is contributing to that now. A year ago, this wasn't really popping in our data, but it's here now, and this is something that brands are really going to have to consider, and restaurants too. So, what do we know about the mindset of the trade-off consumer? If you're going to make an attempt to market to these folks specifically, um, how are they behaving from a psychological perspective? Well, they're here for a good time, not for a long time. They are not good savers. They are not good financial planners. If you look at the saving data that we collect every time we go into field, they're much more likely to be falling behind financially every month than the US average, much more likely to be living paycheck to paycheck, less likely to be saving money at the end of every month. These are not folks who plan well. There's a 15 percentage point gap in home ownership from trade-off consumers to the average U.S. consumer. So these are not folks um, that manage their money well, to be totally frank. However, they dine out more than the average. They over-index on discretionary grocery products like pastries and soft drinks. We could make many cases why perhaps they shouldn't, but they do. So for you guys as marketers, this is something for you to think about as you plan your messaging. So how do you do that? Well, first things first, you have to know your exposure to trade-off consumers. As you saw in my cold cereal and coffee examples a few slides ago, um, the way these folks behave is very different from category to category. Not every category faces the same risk. Not every category has the same opportunity. You kind of have to know who these folks are. If there's one common trend from a product strategy perspective, I would strongly urge you guys to re-examine your pack sizes and your assortments. Not just because trade-off consumers are economically trending toward consuming less volume. When you factor in GLP-1 and the fact that it looks like it's going to grow in prominence, especially in the next 12 months, you really have to think about, does my assortment offer sizes that people who are either cutting budgets or just flat out cutting calories, um, can they participate? So again, pack size, huge things. There is the opportunity to message little luxuries, as I said on the prior slide. These folks don't plan well financially. They may not be able to buy a house. They may be forced to cancel a vacation, but they may trade up on brand for something that seems like a fun opportunity or provide some entertainment value, because they may not be able to get that fun, frankly, from more expensive channels. And then the last thing here, trade-off consumers do over-index on some non-traditional media channels. So broadcast media, TV, radio, no real difference in participation for those types of channels. But specifically, if you're trying to reach these folks, Pinterest, TikTok, Snapchat, those are places where we do see a strong over-index on trade-off consumer participation, which means if you're a brand manager planning a media strategy, trying to get your messages out to these folks, here are 3 channels that we think are viable channels. And we have data on this as well that I can't get into here, that might expose a few more as well. So you got to limit your risk by understanding your exposure and thinking of your pack size situation. You can find some opportunity in the way that you message these folks and where you message them. And if you play your cards right, there's plenty of money to be made in this consumer segment, especially in grocery, because you're likely pulling budget dollars from those household budget items that trade-off consumers are not necessarily as good as planning and saving for, but they will spend up in grocery. So let me stop there. That's 40 minutes of a lot of data, probably spoken at a very high pace for those of you who are not originally from New York like me. So let me stop, take questions. Happy to go back and revisit any data or cover off on any topics if I went too quickly. Sean, how do we look in the chat?
So we have a couple questions, Rick. Question number one. If someone is not a trade-off consumer, what are they? Said another way, what do you call the other 66% of the population? Isn't, in some respect, everyone a trade-off consumer?
Yeah, that's a good question. And that's also a fair point to break out. So we split the total consumer segment really into two broad parts. You're either a trade-off consumer or you are a not or non-trade-off consumer, as we define them in our data. Now, what does that mean? And is everybody a trade-off consumer? Well, to some extent, yes. If you think back to the slide where I showed the macro categories, on average, US consumers are generally trying to trade down on 2.5 of the 7 macro categories that we track. I think that's just natural, common, consumer behavior. Okay, we're all trying to save money somewhere at something. But for the trade-off consumers, to even be considered a trade-off consumer in our data set, they have to be trading down in at least 4 categories, and the average is 5. So out of the 7 categories that we track, a trade-off consumer is only not trying to trade down in 2. So hopefully that makes sense. And certainly, if you've got follow-up questions, put them in the chat.
Next question. You make a point early in the presentation deck, Rick. I forget which slide. But the question is, for the grocery reprieve of 2.5 points of that metric of consumers actively trimming budgets, are you expecting this increased spend will flow into additional private label or more willingness to purchase branded products?
Excellent question. So it's a little tricky to tell with the limitations that we have in our data set. But if you looked at the slide where I compared trade down tactics at the macro level in grocery, we see the desire to trade down on premium brands kind of flattening off. So by converse, we think that the flow into private label is probably also going to flatten off. So we don't see in the near future additional trade down on brand. As more money flows into the grocery category, presumably coming from dining out and restaurant spending, which we do think is going to be, again, a little choppy for the next 6 months or so. Will consumers take that money and actually trade up on brand? We won't know that until we collect more data in November to have a better answer to that. But right now, the trade down activity on branded products has stabilized. So we don't think people are going to necessarily continue to migrate to private label. Excellent detailed question. I don't know who asked that, but they were really paying attention.
Another question. There was a slide where you talk about increase or decrease in intent. Okay. And the question is, how do these increases or decreases in intent translate into actual dollars?
Yep. Another great question. So mapping it specifically to dollars is a little bit outside the purview of what we feel comfortable doing with this data set as it exists today. Now, long answer that nobody wants. Given the time and the funding, I could take this data and regress it against historical spending patterns and come up with a coefficient that would give us a better answer there. But we're not doing that today. No client has come to us and asked us to do that so far yet today. So right now, what we're doing with this data set is looking at how intent to trade down or not trade down compares with participation rates. So that slide that I showed middle of the presentation about restaurant, movie, and leisure travel participation rates. every time we collect this data, we look at the actual participation rate and we go back and we compare that to what consumers said they were going to do the prior collection in their intent. So far, the data has proven fairly predictive. When consumers say they're going to cut spend, especially in the discretionary categories, 6 months later, we find that participation has dropped.
And the last question that we have at this point, while trade-off consumer may over-index on Pinterest, TikTok, Snap, what is the composition? A 300 index may not matter if TOCs total 10 people.
Excellent. That's another very detailed and very good question. So we're looking at this from the perspective of the population at large, and we've got sample sizes that are big enough to be projectable. So in the case of our most recent survey, we collected 4,500 responses. A little over 1,500 of those are trade-off consumers. So when you project that up to 34% of the population, think about the total Pinterest using population in the United States, the total TikTok using population of the United States. Our trade-off consumers are over-indexing by a certain percentage. I don't have the percentages in front of me right now. I think I published them in a report. Might already be up on the website, might not yet. But we could give you more precise data on that with those numbers. But rest assured, it's not a small base. These are consumers that are, again, sizable segment of the U.S. population, sizable participants in all of those platforms, and frankly, all media platforms. This is not a media averse audience. So the over-index is legitimate.
One more question just came in, Rick. For household budget changes, what are your thoughts about the areas that increased or decreased the most?
Another good question. So I'd have to go back and really comb through the data line by line to give you a fair answer on that. If you want to email me offline, maybe we can do that. There are some things that frankly we don't cover very closely because most consumers don't have much of a choice, that have expanded or cost more over the last 6 months, last 12 months, last 18, as we've been tracking this. For example, home insurance. Home insurance has gone up across the board in the United States, pretty much at double-digit rates. Most consumers don't have a ton of opportunity in shopping around home insurance. They can do it a little bit, but there's not a lot of choice out there. And a lot of times people just don't think of doing it or don't do it. That's an example of a household budget line item that's gone up quite a bit. That, again, we don't usually dive too deeply into that because our client base, it isn't something of primary interest to them, but that is something that shows up in our data. Another thing that's in that data that has increased, which I think folks on this call would care about, is the cost of carrying credit, meaning interest rates on revolving credit are at essentially all-time highs, for argument's sake. The balance levels that consumers are carrying on their revolving credit close to all-time highs. So when you think about that, you've got more money out that you owe at the end of the month, and you've got a higher interest rate to pay on that at the end of the month. Most consumers don't pay it all off month to month. And so that carrying cost has gone up significantly since we've started tracking this data. But to really answer that question, we'd probably have to have a private conversation and go through the budget lines one by one. But I love the question.
That is it, Rick.
Well, thank you, Sean. This is fantastic. These are awesome questions. These questions get better and better every time we do this webinar. So people are really leaning into this. And before we all drop, I'll just say to everybody, again, a lot of this data is available on bigchalk.co for free if you go to the Insights page. If you have deeper questions or you're just shy and don't want to ask questions here in the chat, you can also contact us through the website. I'm always happy to try and take some time and talk about this stuff. It's a fascinating segment. So thank you all. Thanks again to Acosta for helping promote this. Appreciate everybody's interest in this, and look forward to catching up with all of you the next time. So thank you all.
Thank you.